Hey everyone, this is Mike Minter with Financial Synergies, and today we're going to be talking about three of the most common investing mistakes we see time and time again and that are just unnecessary, and want to make you aware of these and hopefully you can sidestep these mistakes. And man, if you can do that, you are way ahead of the game. And these are not just mistakes made by novice investors, first-time investors. We see these same mistakes in very seasoned investors who've been doing this for decades, and it just is detrimental to your long-term investing success. So the three most common investing mistakes we see are trying to time the market, number one. Number two, focusing too much on the headlines. And number three, chasing past performance. So we'll dive a little bit more into each of these, but those are the top three that we see. So let's tackle the first, and what I think is probably the most devastating, because it can really derail a long-term investment plan, and that is trying to time the market. What that means, there are variations on this, but basically it means you're trying to time when to get out of the stock market because of some predicted downturn in the market, and you want to get out of the way of that and not experience any losses. And while that intuitively that makes sense, it's human nature to want to try to avoid losses. We're by nature risk averse. It's just impossible to time these things correctly on a consistent basis. And so what you end up doing is harming yourself more often than you're helping yourself. And so trying to time this is just, I don't care if you're a beginning investor or somebody who's been doing this for decades. It's just impossible to do consistently, and very, very, very negative overall to your investment plan. So I've got some visuals here, and we don't have to spend a lot of time on them, but if you just take a look at this first one, so this is just a chart showing if you had missed the best days, and this is going back 25 years. But we're looking at the S&P 500 returns, and this is based on just an initial $1,000 investment. And as you can see over this 25-year period, if you just remained fully invested and didn't try to get in or out, you were up to $3,674. And just missing the best day, you're down to $3,293. And missing the best 5 days, now you're down to $2,322. And just missing the best 10 days, now you're down to $1,685. So you can see how this just incrementally gets worse and worse and worse for you. Just missing a few days here and there can be really, really detrimental. And there's a lot of days over this 25-year period. It doesn't take much to really derail you from earning a great rate of return on this initial investment. Just if you had left it alone and accepted the ups and downs of the markets, you would have been money ahead. So this is just a visual kind of confirmation that it's very, very difficult to do these things consistently. And, on the flip side, maybe you're not trying to get out of the way of something. You've got, cash laying around, and you're saying, look, I really want to wait until we see this pullback in the market, and then I'll put my cash in and I'll be buying at a low point. And again, intuitively, that makes a lot of sense. You're going to buy low and sell high, so to speak, is kind of the name of the game in the stock market. But the problem is, more often than not, the stock market goes up. And so we see it all the time where, you've got your cash on the sidelines and you're not putting it in because you're waiting for a pullback. Meanwhile, the market takes off, it's up 15%, and you're waiting for a 2% pullback. The math doesn't really work out on that. You've foregone this 15% return so that you can wait for this 2% pullback. And maybe that happens, but you're still to the bad on that. It more often than not made more sense to go ahead and put that cash to work if it's for long-term investment. If you don't need the money, in the short term and it's earmarked for long-term investment, it would have been better to just put that cash to work, because again, the market does tend to go up over time, which is exactly why we invest. So trying to time the market, you don't need to do it. And I would highly discourage you from trying to make that a part of your investing strategy. So number 2, focusing on the headlines. So this is a big one. Again, just in our nature, we have a 24/7 financial news cycle. Take your pick. CNBC, Bloomberg, Fox Business. I mean, you name it. There are dozens of them. They're in the entertainment business. They're not in the let me give you some prudent investment advice business. It's hair on fire, doomsday stuff. The negative headlines tend to sell ads for whatever reason. I guess we're gluttons for punishment, human nature. But negativity and doom and gloom sell. Positivity and, hey, look, things aren't that bad, it doesn't tend to sell. And so what are you going to get? You're going to get, more often than not, you're going to get the negative, the doom and gloom. Get out of stocks, run for the hills. Quickest way to derail your investment strategy is to follow the financial media headlines, or the Jim Cramers of the world. Cramer's a very entertaining guy, don't get me wrong, a very intelligent guy, but this is not somebody you want to follow in terms of, basing your investments portfolio on his recommendations. Again, this is a day by day, minute by minute entertainment vehicle. So stay away from basing any of your investment decisions on the financial news, headlines. So, and on the other side of that too, it's not just the doom and gloom and you got to get out because something terrible is going to happen. That's definitely always there, kind of the undercurrent. But the other side of that too is that we can become enamored with popular investments, popular stocks, popular companies, based on recent performance or the massive media attention that they get. And we can tend to over concentrate our portfolio holdings in these companies. So this is another negative thing that comes out of these headlines. Excuse me. So one example would be the rise of these technology companies now known as the Magnificent Seven, right? And these taglines, they change year by year. You had the FANG stocks, then you had Fan Mag. You name it. They're constantly shifting and changing on you as if these are now the godsend stocks that we should all be investing in. And at the time, there's good reason to talk about them. They're doing very well, but it doesn't mean that they're always going to be doing well. So the Magnificent Seven, think of Alphabet, Amazon, Meta, Microsoft, Nvidia, Tesla, all those stocks. So they're the hot stocks right now, and that's what everybody wants to talk about because their returns have been phenomenal over the past couple of years. And yes, it'd be great to be in those stocks, but it's not a reason to go all in, because just as fast as they can rise to the top, they can also fall. And so yes, you want to have access to these, but in a much more diversified approach. So, this is another area where headline news or media attention on stocks is not necessarily a good thing for our portfolios, because we're investing for the long term, not, just focused on the hot stock at the moment. And so we have to be really careful there. And so I've got a visual for this as well. So this is not just zeroing in on Magnificent Seven, but this is actually looking at stocks going back to 1927 and ending 2023. So you can see here, these are the average annualized outperformance of companies before and after the year that became one of the 10 largest companies in the US. So if we look at the 10 years before, the 5 years before, the 3 years before, you can see really just amazing, stellar annualized returns over those periods. and they're getting a lot of attention. And just when everybody's really wanting to pile in and jump in and they're on the bandwagon, we have our start of the first calendar year in the top 10. You can see now returns are starting to dip. And then after joining the 10 largest, the 3 years after, the 5 years after, and the 10 years after, we're starting to see those negative returns. So the moral of the story is you don't stay on top forever. And so it's important to be diversified and not concentrated in these hot stocks of the moment, because historically, that king of the mountain group of stocks has not lasted very long. And we can look back through history, and it's the same story over and over and over again. You had the Nifty 50 in the 60s. We had our internet stocks in the 90s. And now we've got the Magnificent Seven. And before that, it was FANG. You name it. It's the media darlings of the moment. So moral of the story here is be careful with headlines and don't base your portfolio moves on what the financial media is touting for the month. Okay, so last but not least is chasing past performance. So this is these are all very intuitive human nature moves, right? We intuitively want to say and look back on past performance of any investment and use that as a reason for buying it now. And it's not to say that you can't utilize past performance and as a part of your research. To the contrary, we do that all the time, but it's just one component of choosing an investment for a portfolio that we're going to, the goal is to hold on to it for decades and decades, not just based on recent past performance, but we want to make sure that, the objectives of either this fund or this stock, the rationale for going into it is sound well beyond just what it's done recently with its performance. So chasing past performance is, and we say it all the time, it's not a good indicator of future returns. Unfortunately, again, this is somewhat counterintuitive, but it is the case. In fact, and I've got a visual here as well. So, and this is just, we're looking at funds here. We're not looking at individual stocks or anything like that, but just taking funds. You might be inclined to select the investments, these funds based on past returns. So we're expecting these top ranked funds to continue to deliver this outperformance. But can they maintain that performance? And so research shows that most funds, and we're looking at this this little visual here now, most funds ranked in the top 25% based on 5-year returns didn't remain in the top 25% in the next 5 years. In fact, the vast majority did not remain in the top 25%. In fact, only about 1 in 5 equity funds of that 25% stayed in the top performing group, and only about a third of those top 25% funds of fixed income funds remained in that top 25%. So what's the lesson here? The lesson is that a fund's past performance offers very limited insight into its future returns. And so again, there are many other factors and things you need to consider in selecting a fund or any investment for your portfolio. Past performance is a metric that we look at, but it is not the be-all, end-all, and it should not be used to decide solely to decide whether you want to be investing in that fund or stock or bond or anything, for the long term. So you want to take a more measured approach, more well-rounded approach in selecting those investments. So that rounds out the top 3 common investing mistakes that we see. I hope this helped, guys. If you have any questions about it or want to talk through these investing mistakes, please, by all means, reach out to us. We're always here to speak with you. We would love to have that conversation. And if you would like to see more videos like this, hit that subscribe button down below. We'd love to have you as a regular subscriber to our YouTube channel, and we'll try to keep putting out good content good quality content over the coming years. So thanks a lot, guys. Really appreciate you tuning in, and we'll have more for you here hopefully soon. Thanks, guys. Have a good one.